I want to talk to you about the difference between a pre-qualification and a pre-approval. The one you're going for is the pre-approval. A pre-qualification is where the mortgage lender takes your mortgage application and then your credit report is pulled. We use stated income and stated assets for closing. So we're going on what you've put into the application. It's not your job to know how much income we can use or what types of income are used for closing. That's our job as mortgage lenders. So a lot of times you hear of deals falling through, and that's when income typically can't be used or as much income as you were hoping to use. A pre-approval is much better. With a pre-approval, what we're going to do is pull your credit report, just like with the pre-qualification, but we're going to go a step further. We're going to look at pay stubs. We may need tax returns. We may need to reach out to your employer for an employment verification to see how much income we can use. We'll also talk to you about your closing funds. Are you getting a gift? Are you drawing a loan from your 401k? Will you be using future earned funds for closing? Those are all very important things for us to talk about. Another big one that I run into a lot is, where is the money? If you have money, a lot of people feel safer keeping their money at home rather than in the bank. You cannot deposit a large amount of cash into your bank account before closing. So that's why it's really important to have an in-depth conversation with your mortgage lender at the pre-approval stage rather than just a pre-qualification. So you've done your homework and you've become pre-approved. You've gone out shopping with your real estate agent and your awesome agent found you a house. You made an offer and you heard the good news. The two words we all love to hear: offer accepted. But now what? How much money do you need? You will need your earnest money, which is typically 1% of the purchase price. So if your offer is accepted on a $300,000 house, you're going to be writing a check for $3,000 to the title company or settlement agent within the first 24 to 48 hours. The other thing you'll be writing a check for is the option money or the due diligence. That's typically around $100, but that's also a number you'll discuss with your real estate agent and figure out what's competitive. The next thing you'll be doing is a home inspection, and that's also a question for your real estate agent. They partner with many home inspectors that will go around and look at the house and see if they think it has good bones or see any potential issues. That price for the home inspection varies, and you'll need to ask your agent. It is not a part of the loan cost. After the home inspection is done during that first week and everything looks great and you know you're moving forward, then your mortgage lender is going to ask you to pay for the appraisal. The appraisal fees will vary as well, especially if it's an investment property. There will be some additional costs. The typical price is around $640, and that can be put on a credit card. Anybody in your family that loves you can pay for the appraisal to help you. That cost, just like the earnest money, comes off of your final cash to close on closing day. What do I need on closing day? Hopefully this has been a smooth journey and you're excited and have a giant smile on your face. On closing day, you will need a photo ID, which is typically the driver's license, or it could be your passport. Even though you've provided it to your mortgage lender, the settlement agent will want to make a copy. You need to know where you're going, which is typically a title company or a settlement agent. Sometimes it's a notary. Sometimes you may be signing a mail-away package, depending on your circumstance. But you need to know where to be to sign. The other thing that you need on closing day is your money. You need your funds to close. On occasion, that is zero, but not very often. Your mortgage lender will let you know that final number, and you need to check with the settlement agent to see how they prefer those funds to come along. They never accept personal checks unless it's a very, very small amount. So you'll need a cashier's check or a wire. And those wiring instructions, if you send money from your bank, they never come from the mortgage lender. So if you ever see an email looking like it came from your mortgage lender requesting money, then you will know to check that out, because it will not come from the lender. It will come from the settlement agent. One of the most frequent questions I'm asked is, how long do I have to shop for a home once my credit has been pulled? Your credit report cannot be expiring within 30 days of closing, and it's good for about 120 days. So we say you have about 90 days before your credit needs to be refreshed. If you drop off on your home search and you decide to wait, you can always call me back and I will just freshen up your application with updated pay stubs and ask you if anything's changed. Then, once you're under contract, we'll be ready to roll. I want to talk to you guys about two important buckets in the loan process. So, you have your down payment bucket and you have your closing cost bucket. Now, I'm going to come back to the down payment in just a minute, but when I say closing costs, that term is also used interchangeably with including prepaids, which are the taxes and insurance you need to close on the loan. Okay, so we kind of lump that in and say you've got the closing cost bucket and the down payment bucket. So what kind of down payment do I need? We have a zero down VA loan. For those of you who have earned your VA certificate of eligibility, if you need help with that, let me know. We can pull it and we say thank you for your service if you are entitled to a VA loan. Another zero down loan is a USDA loan, which is a rural development loan, and those are income based. And then another zero down loan is if you have grant assistance. There's options, plenty of options out there to explore. Those are also income-based, but they have pretty high limits. So you have some options for zero down, conventional loans, and that's a minimum FICO score of 620. You really want to have at least a 680 on a conventional loan. It all depends, but there's some 3% options there. And then lastly, for an FHA loan, you can go with as little as 3.5% down. So which loan do you fit into? You may have more than one option, and that's why you need to talk to a great mortgage lender who will help you explore it and help you decide what would be the best. Down payment, 0, 3%, 3.5%. Then we go to the closing costs. Those are lender fees, title fees, and then you've got a year's worth of insurance that you always need to pay up front, plus what we call a cushion in your escrow account if you are choosing to escrow your taxes and insurance. And what does that mean exactly? If you're putting 20% down on a conventional loan, you can choose not to pay your taxes and insurance as a part of your monthly payment. You can choose to pay those on your own, but when you do close on the loan, you will pay that first year up front on your insurance. After you do that, you can go monthly or quarterly with your insurance agent, but you'll be responsible for saving for the taxes when they're due at the end of the year. Okay?